August, so investors are focused more on their TANs than their portfolios. But September is just around the corner, and investors might do well to look out. The Federal Reserve said earlier this summer that it would begin to curb its bond purchases this fall if the economy is strong enough. While economic growth was paltry in the first half of the year, there are signs growth is picking up while the job market continues to improve, albeit slowly. So will the Fed pull the trigger this fall? With the debt ceiling back on the table after Labor Day, will Congress rumble over the nation's debt? Will either append the stock market rally and throw the already weak economy off course? Here to weigh in with their outlooks for the economy, the markets, and where to invest now are Uri Landesman, president of Platinum Partners, Patty Edwards, principal and chief investment officer for Trutina Financial, and Ken Farsalas, director of U.S. Equities and Portfolio Manager for Oberweis Asset Management. Thanks so much to all of you for joining me.
My pleasure.
Thanks for having us.
I want to start off with the economy. GDP has grown below 2% for 3 consecutive quarters now. That's below the average growth rate for the duration of this recovery. Yet the consensus is for the economy to pick up in the second half of the year. Uri, what's your take? Do you agree?
Well, it might pick up a little, but not as much as people think. I think that the rich are getting richer and the poor are getting poorer, and that is a poor formula for any kind of sustained economic growth.
Ken, what's your take? Are you optimistic for the second half of the year?
We are. I think that for us, it's about housing, and housing has certainly improved, continues to improve. We've seen signs that the housing market has gotten better. We've got the demand still outstripping supply in the housing market. We've seen pricing start to recover. And we've got foreclosures, for example, at foreclosure starts at new lows. So we think that housing is a major driver of the economy. It certainly was one of the major problems during the recession and in the post-recessionary period. And we think that housing is starting to pick up, and that should help drive the economy in the second half of this year and going into 2014.
Patty, what's your outlook for the economy for the second half? I mean, how long do you purport the economy is going to be stuck in second gear?
I kind of feel like Goldilocks here because I'm halfway in between both of these guys. I'm not excited about the second half per se. We think it's going to be stuck in a small range, not growing that fast, probably for the next 2 or 3 years as we work out of the mire that we got ourselves into with the financial crisis and the housing bubble collapse. That being said, we do think things are going to get a little bit better going every quarter from now on. So we are seeing little things like consumer confidence is at the highest levels in 5 years. Ken mentioned housing. Housing is certainly going to be a big driver. We're getting better exports. We've got Boeing with all of the Dreamliners they're exporting. Yeah, that's only one company, but we're starting to see that get a little bit more pervasive, and we're starting to see a little bit more health around the globe. All those things combined are going to be positive, but they're not going to be uberly positive, just a little bit better than they are today.
Yeah, in our pre-interview, you said it could take another 2 to 3 years before we're really out of this muck, right?
Right, and if it's looking at employment, for example, if you take peak employment and look at how long it's taken to get back to peak employment levels for the last 6 recessions, we fell over 6% this time, which is further than any other recession in the past 50 years. And we are still about, I believe it's about 1.5% below peak employment levels. It's 69 months. The longest time it's taken to get back in the past 50 years has been 48, 49 months. So we've got to get that employment back, and that's going to take a long time because you've got job retraining that's got to happen. You had a lot of 50-plus-year-olds that came out of the workforce that retired earlier than they thought. Those are a lot of dampers on the economy.
Well, I mean, to your point on the employment outlook, I mean, what does that spell for consumer spending here in the second half of the year? If you looked at the most recent employment report, you saw hourly earnings had fallen, you saw weekly earnings had fallen, mortgage rates have now ticked up, the new sales numbers out for back to school have been weak. I mean, does that give you pause?
Yeah, I mean, it certainly gives me pause. Those are amongst the things that are really concerning me. I just don't see the kind of broad-based demand pickup that I think we're going to need to go from sub 2% growth to over 3% growth. And so that translates into concern for the stock market, given that multiples, I think, are discounting organic growth rates that are going to be unachievable given this dichotomy.
Yeah, Patty, were you going to weigh in here?
Well, I was going to say, that falls right into what we were saying. It is slower. It is, back to school is not looking that good. On the other hand, look at what vehicle sales have done. People, I think, are changing their spending patterns. They're not completely curtailing them, but they are changing what they're spending on and how they are allocating their dollars. And a lot more of it's having to go to things like housing as the interest rates tick up.
Well, let's talk about the outlook for housing, because to your point, that's been the major driver of the economy so far this year, aside from autos. Ken, you think that the housing recovery will be the impetus for higher growth in the second half of the year, but are you worried that the uptick in mortgage rates could pull the wind out of housing sales, if you will?
Well, I think clearly it's had an impact in the very short term. I equate it to sticker shock, and certainly the rates that have gone up around 100 basis points here in the last 6 to 8 weeks, I think that started to have a little bit of an impact in the short term on housing, as people have to digest the fact that rates are now approximately 100 basis points higher than they were just 2 to 3 months ago. But if you take a step back and consider still that interest rates, mortgage rates in particular, are still essentially at all-time lows or very near all-time lows, and housing affordability is still at record affordability levels, particularly related to rental properties. Rents have gone up significantly over the last 4 to 5 years. So even though rates have backed up a little bit, I think we're still set up for additional housing strength as we go into 2014, because we're still at historically low levels. And I think people have to get over the sticker shock by rates going up 100 basis points. I think as long as rates don't move materially higher from here, housing should be okay.
Uri, what's your take on housing for the back half of the year? I mean, typically that's been a seasonally slower season for housing. We are seeing the uptick in mortgage rates. Do you think it's just a little bit of sticker shock here that we can get over?
Yeah, I mean, Ken's point is well taken, I think, on two fronts. One is clearly housing is the part of the economic recovery I believe the most, and I certainly buy into his notion that on a historical basis, rates are still incredibly low, albeit higher than the ridiculous levels that they had sunk to. Clearly, you're going to need rates to level off here, or else you are going to have, if not a problem in the price of houses, more likely what you'll see happen is just much fewer transactions. But the part of the economy that's going well is people's homeowners' perceptions of how much equity they have in their homes. That is significantly better than it was, even 6 to 12 months ago.